Hi, I'm Roger Conrad. I'm co-editor of MLP Profits with Elliott Gue. What I want to talk about today is basically a position we just took took a sell on. We had a 120% or so gain in this, and we sold. Judging from some of your reader feedback, it was a little disconcerting to some people. Maybe you're not used to taking a profit on an income stock. I think what you have to do, though, going forward, is take a little more proactive approach to your portfolio. And our favorite holding period for these things is forever. We like these underlying businesses. We especially like the ones in energy and involved with energy infrastructure. We think the Williams combination of its two limited partnerships into a larger entity, which will become one of the larger ones in the country, we think that's very, very bullish. And we think it's created a very solid MLP that we're going to be writing about for a very long time. On the other hand, you take a look at the kind of gains that we've seen in a very short period of time as this combination was announced. Compare them against the dividends. Some of you have said, well, we bought Williams at a much lower price, so we're getting anywhere in the teens as far as an annual yield on our original investment. Very good. And in fact, kudos to you for buying a very high quality outfit at a time when most other investors were running screaming and holding up in bonds or money market accounts. And that's a very good thing to do. But by taking a profit here at this price, taking this enormous profit, actually a bigger profit than we're taking in the newsletter ourselves, you're also clearing out a lot of money you can reinvest in things that maybe yield a little bit more than 5–6%, which is what this thing is yielding right now. So while you pay some taxes, you're paying capital gains, while you're forfeiting maybe the fact that you're in a very low cost basis, you're also maybe leveling off your future taxes and increasing your future yield. So don't be averse to taking these profits. I mean, after all, if you're scoring 100% capital gain, even if you are getting a 20% dividend yield in your original investment, it'd take you 5 years to get to the point of this gain, which you've been given in a month. You don't have to sell forever. You can sell, you can get out, you can keep some money in it, you can put some money back in when the price comes off. And as we've seen, these things can be extremely volatile, particularly when they issue new shares. So we're not going to do this very often, so rest assured this is not a trading service, but you really do yourself a disservice if you marry yourself to some of these plays. And if you're not willing to get out if an underlying business starts to come apart, but if you're not willing also to lighten up when you have a tremendous gain and just take the gain and balance out your portfolio, you're also doing yourself a disservice. So look for some of these things to happen down the road. Again, like I say, we pretty much like to stick with our positions. We like the wealth building model that MLPs have to offer. You have to stick around to get the dividends. You got to stick around to get the tax advantages, certainly. But there are going to be some opportunities there to take a little money off the table, to redeploy it in something that's more profitable. And we will be doing that. We'll be explaining why we do that. You can follow us. You cannot follow us. We're going to keep following Williams, for example, in our coverage, in our How They Rate universe. But we are going to be looking to take advantage of some of these opportunities, particularly now that we have seen some of these monster gains over the past several months. So thanks for tuning in. We'll look forward to chatting with you next time. As always, if you have questions, please contact us, drop us an email, and we'll be happy to answer. Thanks very much.